Thanks so much for tuning into Talking Point today. I'm your host, Neeraj Shah. Our guest today is somebody that I always look forward to because no conversation with Mr. Samir Arora can be complete without talking about his tweets. But more importantly, in today's conversation, I want to talk a bit about his view on the global landscape, on the Indian AMC landscape, since they are making up, they've made a pitch or they made a beeline for that as well in some fashion. And Samir, please correct me if I'm wrong. And of course, his views on how the current India investing landscape looks like. Samir, so good having you. Thanks so much for joining
Thank you
in. I
so
hope
much.
all is safe.
Thank you. No, all good so far. Although every day is more scary as you hear about more and more cases. But otherwise, yeah, so far so good.
Hopefully peak soon. So let's talk about let's start off from the top and then kind of navigate to the micro. What's your sense? The last 2 days, the global markets are caught in this dizzy of rising yields, the expectations out on interest rates having risen. Any thoughts that you have, whether you agree that the Fed is behind the curve or kind of on the ball, and even if rates were to go up, could that have a negative impact on the markets?
So the thing is that right now they are keen to calm the markets again. Yesterday they came out and said that this is transitory, and then there are questions that what is a transitory period? I mean, is it like 6 month thing or a 1 year thing that you will accept higher inflation from commodity prices and the fact that so much money has been printed? It is clear that inflation will come. If you see even employment did not go up as expected. What does that mean? Is it that there were no jobs, or that is that the people who are getting money sitting at home didn't feel like going for work for whatever salary was being offered to them or wages were being offered to them? But I would still think that the rates today are lower than what they were prior to the start of pandemic. Let's say Feb 2020 or December or whatever, the rates, the 10-year rate was around 2%. Now it is what, 1.6 something. So I would think that at the first level, going back to that level and then getting shocked would be, it's too much to ask from the markets. Because if in the US we say that over time the jobs will go back to those levels of 3.5 million, 3.5% unemployment, from whatever it is, 6% or something, and that markets will go up and the GDP has grown and everything is true, everything has gone back to pre that level in some time, that interest rates should remain what they are now. That is number one. And in a big picture sense, I have believed over time, although I don't have much statistical data except for one period, that if interest rates are going up because there is also a genuine recovery, a cyclical recovery because of whatever may have happened last year, a little bit of interest rate hike is okay and will not disrupt the markets. So my favorite example for that is the period 2003 to 7, where I believe that the interest rates in the US were hiked 17 consecutive times, 0.25% each time. And it, I think, ended at 6 point some percent. And it had started from these 2-ish percent because of after September 11, interest rates had been cut. And then they started increasing them, I think, from 3. You can check it on the net. But it was definitely, in my memory, 17 consecutive hikes in every meeting. There was a hike of 0.25%, and we had our biggest bull run in those days.
So, I mean, point being, I mean, okay, one is whether it will happen or no, but two, whether the fears of that happening, will it bring about a corrective move or no? Now, there is some study done by, I mean, various people do various studies. Your firm must be doing them too. And I was reading a blog or a newsletter which suggested that pandemic-induced inflationary moves are not typically that strong. And even if this were to come up, they are on the camp of what the Fed is saying, that it will be transient in nature and the markets need not worry. And the Fed will be out there calming the markets, even if the expectation in the yields were to move up. Would you believe the fear of it could really damage the markets, or would it be volatility at best and not really permanent
No, the
damage?
thing is that, we have seen many corrections of 10, 15% in markets without exactly any of the fears coming through. So it's possible that a fear does it, but for many months and quarters, I will not believe that interest rate hike or a little bit of inflation is for me to worry about. So if it happens like that, we will let it go for some time. So in that sense, possible that it happens, but it won't bring about any change in our side, in our actions. But the thing is about pandemic-induced inflation. I have no idea that how many pandemic data we have to see what happened in the past. But I would say, as I said, I think the simpler way to look at it is that if pre-Feb 2020 the rates were 2%. First of all, don't ask anybody till it goes to 2% because you want every other economic number to be back above the Feb 2020 numbers except interest rates. So that means these are just fears that the market creates to put pressure on the Federal Reserve, is how I think it. Not that there is any one person doing it, but that is how markets, squeeze leverage. They squeeze somebody's indiscretion because the market just act against it. In this case, maybe they're putting pressure on the Federal Reserve because they just want lower for longer rates.
Yeah. Well, actually, that note speaks about how they have data for inflation dating back 200 years. And in those 200 years, there have been a number of pandemics. So that's how they managed to dig out
Maybe.
that data. But anyway,
Okay.
yeah. So, okay. So having said that, where do EMs and where does India fit within there? Because I think EMs or Asia Pac we had data yesterday on the Bloomberg which showed that in the very near term, Asia Pac has underperformed DMs by a reasonable margin, and India within that even more so, for obvious reasons. How do you
So
juxtapose
first thing
India within
is,
the globe?
so if you look at the last 3-4 years data, maybe it's longer. I have it live with me, 4 years data from 17, 18, 19, 20 and year to date, which according to me shows that India has separated from emerging market in terms of flows. What that means is that if India gets 20 billion inflows, like 23 billion it got last year, okay, as FII flows. Now, if India is part of an emerging market basket and not an independent allocation, then India's weightage is some 9% in emerging markets. Therefore, broadly speaking, emerging markets should have got $200 billion. And emerging markets had massive outflows last year. Just in Asian emerging markets, ex China and ex India, the outflows from Korea, Taiwan, and all these other places in Asia was $55 billion, while India got inflow. This has gone on for 3-4 years in a row, where when the outflows happen, India loses much less, like it happened in 18, I think. But even this year, India's had some 7 odd billion inflows, and the rest of Asia, ex China, has had some 18 billion of outflows. So the big picture, according to me, is that India is not getting money only because people are putting money in emerging markets. India is getting, according to me, now as a second separate allocation after China, which means, let us say that you wanted to put 10% in emerging markets. So in the olden days, you would have put that money in some emerging market funds or created that weightage yourself. Now you might be saying, these foreign investors, big investors, that let's say we are putting directly 4 or 5% of that 10 in China, and we are putting, say, 1% or 2% separately in India. And then the balance 2, 3, they may be choosing countries or they may be just choosing the emerging market index for that. Because I don't think they are so interested in a package buying Latin America and Africa and Russia and Middle East and all these things which come along with the package. And that is why India has actually done very well and very different from its weight in the emerging markets index,
You reckon
at
that
least for
can
the last
continue,
one.
Samir? You reckon
Sorry?
that can continue, and that should be good news for you, right? I mean, I'm just thinking
Yeah,
out
yeah,
loud
yeah. No, no,
for
but
Helios
that
as
can
well.
continue means it has been continuing for 4-5 years. So it's not
4 5 years
1 week or,
now.
yeah,
Yeah,
17, 18, 19. I have the data. I can send it to you later. It's from a Goldman Sachs report, actually. But I have interpreted the table like that because it clearly
sure.
shows that India is getting inflows when the rest of the region is getting outflows. Or in 1 year, the region was having outflows, but India had only like very small outflows, which was in, I think, 2018. So it means, how can it happen? This can only happen if you are not getting money as part of an emerging market allocation. You are getting it maybe within the emerging market allocation, but as a country allocation, which actually makes more sense. For 20 years, I've been saying to everybody that when you buy in an emerging market fund, Korea and Taiwan and all that, it makes no sense. because those are developed markets. They are not the characteristics of what you think from an emerging market, which is that this is a catch-up trade, this will go on for 20 years as these emerging markets become middle income and whatever. But because of rules related to stock market ownership, those countries are called emerging markets. Not so much from the country point of view, but only the way
Hmm.
foreigners are treated in as owners of equity. You have to be approval. You need an equivalent of an FII kind of thing, and it's those things which make it emerging market. But the investor is not really choosing it for that reason. He was in his mind choosing it because he thought there is this vast potential in, say, China, India, Brazil, and at one time Russia and all that. Very different from the biggest weights in that index.
Yeah. No, actually, okay, let me rephrase my question. Do you reckon that you, for example, I rather not you reckon, are you looking through this current wave of rising cases and keeping your allocations or increasing in areas where there might be valuation comfort, even though the cases in India are rising?
So the thing is, we are an India-only fund, a long-short
Right,
fund.
right.
So
Of course. Yeah, yeah.
We have changed. So we'll always be invested, or we might short a little bit. So in that sense, when we talk to new investors, even now we speak to new investors who are not there in our fund yet, that this is a 3, 4, 5 month problem. Except that the problem will change many sectors and will put back India a few months, more than 3, 4 months. I think because these will leave scars, which are not just that, okay, 3 months later, everything is back to what it would have been otherwise, because there will be fear. There will be fear of a third wave. There'll be just fear in general. There'll be a little bit of gloom. There'll be, if there is one person dead, then 5 people, 10 people are affected. Their trust in the thing that they have to save money, that they can't splurge, all those things will change for some time at least, I would think. I mean, at the very minimum. And therefore, I think within our sectors, we have made some changes and sold off. For example, microfinance companies. Now, how do you expect these guys to go and collect uh, their installments, which are weekly, and everybody's being put back? Plus a second wave, and then a fear and comments by people on the third wave means that everything will be on tenter hooks for quite a few months. So in that sense, we will change our net and have changed it a little bit. But big picture, I agree. I just wrote an article for Outlook magazine. We have seen it too many times that the markets are ruthless. They went up in the week after 26/11. In a few weeks, not few weeks, but maybe a few months after September 11, they were up. And they've been up after all these events, because that is how the stock markets work. They're cold blooded, and it's just that in the middle of it you feel very bad that what is happening. For example, today the Taiwanese market, because yesterday there were 10 cases and they feel that these guys have not been able to control, is down. It started down 8%. In India, we say who cares. So that sometimes looks very, very bad to me as a player in this market, and I try not to, because anyway what we have invested, and we may change it a little bit, but I don't like to celebrate rallies in the middle of this thing. After 1 year we'll say, see what a resilient market we had. Right now I think what a ridiculous thing that we don't care.
Yeah, pertinent
There is
point
a very
in
fine
that.
difference between ridiculous and resilient. When you're looking at it as a graph, when you're looking at stats in New York, they are statistics. When you look at numbers in Delhi, and that you're scared to even look through a video or look through a somebody's article, then you know that this is not a stat, even if you don't know that person. So that is how things become different when they are happening in your own neighborhood.
Yeah, no, no, well put. But so, well, I mean, that's a conversation that can go into a completely different tangent. So I'll kind of stay. But I empathize, Samir, and even more so, it's been a daily chore to try and
Okay.
help out some people for beds or ventilators. It's been a terrible time the last 1 month, I must say. Just one quick follow up on that before I get down to some nitty gritties. My question therefore would be, Samit, that if you, because you said that the Indian markets kind of are a bit ruthless, if you were to,
No, all
and you
markets.
must
All
be, but
markets.
if you were, all markets, yeah. No, because you said Taiwan was this way. That's the thing. But if you were to get in some more flows currently, would you be tempted to sit on a bit of cash currently, or would you believe that no, you're comfortable putting in the money to work because you have that view of 6 months out?
No, we are putting it to work. And only thing, as I said, is we have changed a few stocks in our long only product, which is basically that we are buying less of consumer discretionary, home improvement, because all those things played out in the first round because there was, first is when you were sitting at home, you realized that you needed something, you needed a laptop or you needed a table or something because you were now supposed to work from home and therefore create a little bit of space that resemble that. Second time, that is not happening. Second time it is not happening, then when there are so many deaths in the neighborhood that you're going out buying televisions and air conditioners and refrigerators in the middle of that, and it may come back and it may. So because of that, the financiers of these durables and the owner, I mean, this thing you have wasted basically 6 months. So with new money, we are still buying our tech, pharma, specialty, chemicals, financials, and we are still buying some consumer, but we have just reduced that weightage and changed the angle a little bit.
Okay. Can I start off though with one piece that you didn't speak about, and I'm a bit of a conundrum here, which is why your views would be very welcome, and that's commodities. And first start off with metals, because every note that I read speaks about one thing, that Indian prices are at a discount to China, and
Yeah,
therefore
yeah.
there is
Today
room.
also.
Yeah, today also, right? My
So our
question is,
theory
would
on
the
that is very
yeah,
simple.
please. Hmm.
We don't like commodities, but we are not saints. We have to understand the world. So we own 30, 35 companies. Our formula has been that we own 29 because we genuinely like them, and 5 we choose from the rest of the universe. Because if I buy 5% into commodity stocks, I am covered. If it goes down, it's okay. If it goes up, I make some extra money. But I will never lead in these things. Because our three things that we like are financials, consumer, and this tech pharma type. But there is only one or two other things, which is sometimes a commodity company, sometimes some capital good company, sometimes some infra company. Infra company you have to buy one, and you can cover yourself, which is called L&T. Commodity companies you can buy two, Tata Steel and Hindalco, and you are covered. So why waste your life over this? Buy two companies and move on in life. My previous record, as I've always said, is that when I have got desperate enough to buy these commodity companies, the peak happens next morning. But it's fair money spent for stopping that rally and letting me move on in my life instead of worrying every day what the hell is happening to these stocks. I have bought these now with a 5% total and said, let's see how far it goes. Because the record is that I have never made money. But we are not, this thing that, I can never buy it because this happens, that happens. This is part of a cycle which happens every time. I need to cover that. And out of the 20 commodity companies and 10 capital good companies, there'll be one which is better than others. So that is a good start.
Are you desperate right now, Samir?
No, I have already done it, I said. So now let's see whether the market can. I already became desperate.
Okay, fine. Sure, let's see.
But the
Just
point is, I have done it for 25 years. It works. The model works. The model works because if it does well, you will do a little better than what you would have done in not buying. If it doesn't do well, you will be again number one because all the other guys who overdid it are now back to. So the point is, these things happen around turns. When
sure.
the markets have because some of these things don't turn, like the consumer generally does well, it been a little bit under that pharma tech has generally done well over 25 years, private financials have done well, but it is once in a while a new thing that comes up. For example, last year at the beginning of the year we didn't have any pharma, although we like pharma, but we had taken that allocation and put it more into IT. So, but when the COVID thing came in March, we said, we don't have pharma. We waited what to do. Is it really And then April, we said, okay, we anyway have some favorite stocks in these sectors, except that totally we can only buy X number of stocks and totally 100 rupees only to invest. So you change two, three stocks and you adapt to the new world again, you do well, which is what we did last year. We were at more than 25% for the whole year in our offshore fund with the shorting also. So that's how it is. You have to be a little bit practical while being a fund manager. The strategists and the analysts can be theoreticians.
Okay. Last couple of questions, Samir. The last one will be on your mutual fund thing because we haven't spoken about it. I would love to just hear your thoughts about why, etc. But just before that, one question on IT. And my question is that there is this very large dichotomy in the sense in my 17, 18 years, there are not too many instances when I've seen such disparity between valuations between large cap IT and mid cap IT. Maybe I'm wrong, but at least I don't remember having seen it to such an extent. What's happening here? And if you are constructive on IT, are you buying on the high growth but highly valued mid-sized companies?
No.
Or
we have one or two of those which are not very high growth, but they might be a little higher growth than the TCS and Infosys, but they are not growing 30-40%. But I think the tech over time has become, there are various angles to investing in tech. One is, of course, that now if there's any slowdown in India, any problems in India, you're a little bit distant from that. Second is India did not have pure tech companies, so it's an indirect way of playing the US and the global tech industry, which we never directly got to participate in the India fund. And third is that over time, the valuations of the consumer companies became so high that you could start dreaming that what is the real difference between our TCS, Infi, and these Nestle types which grow at half the rate and have double the multiple. And so you could fit it into various angles and justify owning a reasonable stake. So for us, we will have maybe 20% in pure IT services. And they have done well for us over a reasonably long time. And of course, they did very well in the absolute olden days. But we are not every day looking for a new IT company to replace a current IT company because it has slightly better growth and all that. These things are, over time, not worth the effort unless you are basically a mid-cap fund and only trying to buy the highest this thing. But I would think that a portfolio for any individual investor who's watching this should have IT, and they can have a mix. There are one or two. You don't have to make the whole portfolio to give you the highest bang for the buck, because we have seen that those stocks also fall the most when anything goes wrong, as it is happening in the US right now in the non-FANG tech stocks.
Yeah, well, Kathy Wood, ARC, tech fund.
So she was selling the big tech to buy the new high growth. And by the way, I also believe that high growth is not enough for any company. We use this slide in one of our presentations that Infosys from 2000 to 2005 had its earnings growth of 45% per annum for 5 years. And the stock price did not go up even, I think, 2% per annum. So this idea that high growth will take care of many things, it doesn't. When things turn.
When things turn. Fair point. Thanks for that, Samir. It's an interesting anecdote. Last question, and maybe I misunderstood, Samir, but you guys are thinking of a foray into the AMC, retail AMC space, right? Can you tell us a bit about that?
No, nothing to say today. We realize after some time that there's a big local market. We have been always operating as a foreign investor, that is raising money from foreign investors to invest in India. And we can easily do the same from Indian investors to invest in India. So we started this PMS business. And as part of thinking that how far that can go, we realize and there'll be a next one, which is mutual fund. But that takes a lot of time for approval. You've seen these other guys get approval within, not less than 9 months, 12 months. So these are longer term things we have put in our application. And when we get signs that approval is near or some milestones have been achieved in terms of what the regulator wants, then we'll think about properly announcing to you. But right now, it's just an application in the system. There's nothing more than that. Except that it is a natural extension two, if you are going for the PMS and getting into various distribution channels with the banks and distributors, that over time, once you are there, then you might as well take it to the full extent. Plus, I have always been a mutual fund guy. This will be my third attempt, and third attempts are normally successful because it's in a third time successful.
Well, wish you all the best for that and more, Samir.
Thank
You
you.
deserve it. But thank you so much for speaking to us
Thank
today.
you.
Really, really nice of you.
Thanks a lot. Thank you.
Yeah. And viewers, thanks for tuning into this edition of The Talking Point.